welcome. You're watching Business Today Television. This is Market Today. I'm Sakshi Batra. As we start off another day, well, we've actually seen the week start on actually a lower note. The bulls until yesterday were actually desperate and fighting tooth and nail to defend that 22,800 mark. But with that getting tested on the lower side, now decisively the level to watch on the downside has been fixated at 22,500. Remember, even yesterday we did see over 1% kind of a fall as far as the Nifty is concerned. We slipped and ended the day at 22,553. So that's now getting lower and lower as far as the index level is concerned. Even the Nifty Bank, for that instance, even though it outperformed the Nifty yesterday, it fell for the third consecutive trading session. Now, even though it was an outperformer yesterday, it has actually corrected 1,000 points in just the last 3 trading sessions alone as well. Broader markets continue to be under pressure. As of yesterday, we only saw the pharma stocks, slight gains in autos and FMCG continuing to stay put, but rest of the pockets were definitely deep in the red at this point in time. Very, very select few stocks were up and about in trade. Now, as far as the global cues are also concerned, remember on the Wall Street, the S&P 500 dropped by 0.5%. Second day in a row. We've also seen the Nasdaq decline by 1.2%, continuing the decline from Friday's sharp lower losses that we had seen. The Dow Jones, however, bucked the trend, ended about 0.08% higher in trade. But remember, it was the weakness on Friday that we had seen on Wall Street that has also dampened the sentiment for the Indian stock markets on Monday morning as well. As of today, the Asian markets, as far as the early morning trades are concerned, again point to a large negative. We see the Chinese index down by 0.4%, Hang Seng down 0.6%, 1.2% loss for the Nikkei. The Kospi also down by about 0.4%. The GIFT Nifty is indicating right now a flattish start at 22,586. Let's hope that this improves for the better, because in the early morning trade, it was a lower start on the GIFT Nifty. It's now improving. Let's hope that this continues to be the case as well. Now, as far as the flows are concerned, the FIs continue to be sharp sellers of the Indian stock markets. The foreign institutional investors have net sold shares worth about 6,286 odd crore rupees even in yesterday's trading session, while the DIIs did compensate most of it by buying shares worth about 5,185 odd crore rupees as of February 24th. Now, what's happening in the US is that the US President Donald Trump again has confirmed as of yesterday that tariffs on imports from Canada and Mexico will proceed as planned once the month-long delay ends next week. He also stated at the White House press conference that the tariffs would go forward on schedule, stressing that the U.S. has been taken advantage of by other nations. Donald Trump reiterated his stance as far as reciprocal tariffs are concerned and intentions to impose them are concerned. He asserted that they are going to make up a lot of the territory as well. So the Trump tariff talk has created further troubles across the world markets, including in the Indian market as well, and that seems to be another point to watch out for in today's trading session as well. Remember, this is a truncated week of action. Tomorrow again will be a holiday on account of Mahashivratri, and we are in the F&O expiry week for the series 2, which has been a big negative one again, the 5th month of losses as they continue. Let's in fact welcome our guest on board. We have with us Mr. Dharmesh Kant, who is joining in as far as the morning edition goes. He's the head of equity research at Chola Securities. Warm welcome to you, Dharmesh ji. Good to have you with us. Dharmesh ji, the market sentiment is further weakening. We were hoping that 22,800 could be an interim base and therefore the markets could bounce back, but that's also got tested, and 22,500 is what we are looking at this point in time. Are you worried that we could probably see, some more sell-off from here on as well before finally moving higher? And what exactly are you advising clients at this point in time?
Yeah, good morning, Sakshi. I mean, the nature of the market is always to do things in excesses. So when it goes up, it will, do 5-10% extra on the upside. Similarly, on the downside, this cannot be ruled out. It can be 22,000 or 21,800 kind of levels, or even the 4th June lows on the election day. So those things are possible. What is worrying is the consistent and heavy selling by the FIs, which continues unabated. So that's the key question to be answered: why this selling is happening? And to my mind, I mean, the confusion lies on the valuation multiple. So one is reverting back to the mean levels. So large cap and mid cap has done that. Small and micro cap is still away from the mean levels. So, but the problem is whether we are going to see a resetting of these mean levels as well. So that has to be seen. I mean, if you look at China for last 30 years, the index CAGR is only 3.6%, whereas for India, the index CAGR is 14.5%. So a huge difference out there. If because of tariff and localized economies, the money portfolio allocation, the money shift allocation gets a change, then there can be some more pain out there. So what we are advising our clients is nothing to do with sectoral bets. So we are staying away from taking a blanket call on a particular sector or something. It's a completely bottoms up kind of an approach. Though the stocks are coming down, even our recommendation, and we recently put out a note on NTPC Green Energy as well. So things are moving down. It's not going up. But if you are sticking to quality stocks and doing maybe a systematic investment plan kind of equity allocation to those particular stocks, so maybe 3 years, I'm sorry, 3 months, 4 months down the line, things can improve quite reasonably.
3 to 4 months down the line, things could improve quite a bit. At this point in time, there is some weakness that could actually persist in the current realm as well. But, I want to also understand with respect to the mid and the small caps as well, Dharmeshji, what is your approach right now? Is that also a space where slowly and gradually higher allocations towards from SIPs should be going to, or is there still a lot of caution to be presented?
Sakshi, again, I mean, in mid and small cap, like every bull market, and after the corrective phase sets in, the next bull market, the darlings are not again the darlings of the next bull market. So what happens is if you are trading at say 50, 60, 70 kind of a P multiple in the bull market cycle, whereas natural average growth can at best be 25, 30% or maybe 35% CAGR for 2, 3 years, and then the mean takes place, and then 20, 22% kind of a CAGR if you are do for next 5 years, it's commendable. And that is where, value migration translates from say small to mid or mid to large cap kind of a thing happens for a company. So what has happened in this cycle, I mean, last 3 years, so wherever, the stock price has gone up very high and they have corrected now, we don't think those stocks will again regain the momentum and scale up new highs. So it's very difficult. It's very difficult to get those P multiples. So it cannot be a blanket call out there. And the other notable part was when we looked at the earnings which have been reported. We studied around 625 companies' earnings to that extent. So it was 3.5 to 4% kind of actual pro forma PAT. That is, if you exclude the extraordinaries, growth for mid and small cap basket. Whereas market, I went with the analyst estimate whether it was one or two broking houses. They're still penciling a 20-25% kind of a profitability growth, which looks very difficult when you have a GDP growth decelerating. The government itself is accepting the fact, and the lead indicators are also not suggesting that such kind of a growth will come back. So the pain is there in mid and small cap. They have still not corrected to the extent they should have because of the domestic flows, which are still very strong. So there you have to be careful. Apart from that, I mean, again, stock specific, you are in the right basket, then maybe still you have a story for if you are holding it for 2 years.
Markets have started to tick as far as pre-open is concerned. Viewers, we have now 22,400 in front of us. In the pre-open, at least 22,500 has also been tested, 0.5% lower. In fact, we tested this level also just at the opening tick, but we'll see whether this improves for the better. Right now, a 0.8% lower in trade. 22,375 now, 180 points lower as far as the Nifty is concerned in the pre-open trade. Let's actually look at some of the heavyweight counters to see if those are the ones that are exerting further pressure. Let's look at Reliance Industries. Let's look at banking heavyweights, HDFC and ICICI. 1202 for Reliance Industries in the morning trade, about 1% lower in the pre-open space. HDFC Bank 3.7% lower. Let's hope that this improves for the better, but right now 1615. That could be a big pain point, and that's why the indication likewise. ICICI Bank, however, still in the green, 0.4% higher, 1223 is the current level. Let's look at the Axis Bank is also down in trade, but IT heavyweights, flattish trade with a negative bias on TCS. Remember, IT stocks yet again were the big pain point as of yesterday. Infosys flat with a negative bias as well. So that's as far as some of the heavyweight counters are concerned in the pre-open space. Let's get Dharmeshji into the conversation. Dharmeshji, wanted to get a sense on the IT space particularly. Why do you think there is this extreme caution that everybody is now looking at IT with? I mean, a few months ago, this used to be the space that everybody was positive on, and suddenly the sentiments have turned sour, and there is a lot of caution that everybody is asking us to really look at here. What has changed for the IT pack?
Yes, actually, I mean, you can cast me as an outlier to the IT basket. So we missed the initial rally when the stock prices went up, but we got the right on the fundamentals part. So the earnings of IT companies did not move up to the extent, though last quarter was a bit better than the first half of the year.
Yeah.
But again, if you are having a, say, I am talking about large caps, if you are having a PAT run rate of say 8 to 9% or 10% kind of a profit growth in INR terms, again, then why you would be paying a P multiple of say 20, 25 or even 16, 17, where if you look at the capital allocation of all these IT companies, they're sitting on large cash balances and it's not being put to any productive use. So that itself justifies they are lacking on the business growth opportunity front. Until now, management has been able to guide on the stability part. Whatever they are doing, they are saying that we will not go down. We can be able to maintain these kind of a level. So that's a problem area out there, and I think a lot of rejig is likely to happen on the IT platform as well. So this quarter commentary would be very significant in light of whatever development they are seeing in the US. The run-up initially, to my mind, is more to do with the rupee depreciation initially. So that trade was there and that trade is now over. So unless ITs have a clear-cut, roadmap of how things are going to improve and get back to 15, 16% kind of a growth trajectory, I don't find it compounding kind of investment bet. It's more of a trade which will keep on coming because of the stability of earnings. You do have a defensive kind of a play in the IT space as of now.
In contrast, do you think that pharma is something within the defenses that one should really look at this point in time, sir? What's your take there?
Definitely, that was the call always because the numbers were also very good and they have been doing around 20, 21% kind of a PAT CAGR for most of the pharma companies. They were able to do so and they have diversified their portfolios well. I mean, Middle East, they have been diversifying, African countries, they have been diversifying with India portfolio swelling as well. So, but that tick marks were there. But what happened with Mr. Trump again announcing some, tariff threats
Yeah.
on the Indian pharma companies? So that played a spoil sport. So that correction has happened. But it would be a blanket tariff call because most of the Indian pharma companies are generic pharma play and they supply. So there the tariffs are already low. So I don't think those they are not patented players, so they won't be impacted to that extent. But markets are nervous, and this time any negative news flow which surrounds the market is being given more credence to, and the voltage of selling increases dramatically. So that has happened. But to my mind, pharma as a space is a better player to in this market than IT companies. So they, I mean, the likes of say Sun Pharma or Cipla or Indo Pharma looks to be a better bet to me than pure IT plays.
Fair point. But let's also discuss the third defensive space, and that's the FMCG, where more disappointment has occurred. I mean, it has underperformed the Nifty by a wide margin.
Yeah.
It's 20% down from in the last many months, and already in this year itself is down by about 8 odd percent, underperforming the Nifty. Now, this was one space at the beginning of February when the huge tax bounty was announced, was being seen as a turnaround sector and a story that could emerge as the most positive, but things have again slipped from those peaks. What is your own take as far as the FMCG counters are concerned, sir?
Actually, if you look at FMCG companies, first they are fully owned. So last 3 years, nobody has been able to get an exit from the FMCG counter. I'm talking about the institutions and the large fund houses. So they did not have any stock price traction in those companies who get an
Yeah.
exit. So they are stuck out there. Second, the volume growth has been very anemic. I mean, there is no volume growth happening out. The best you can talk about 4 or 5% kind of a volume growth, and blended price realization is always a question mark. So there you are not getting any appreciation. So again, you are ending up with say 8%, 7% kind of a profitability growth, where the valuation multiples are still very expensive. It's plus 20% plus kind of a valuation, 20 PE plus kind of valuation multiples most of the FMCG basket are standing on. I understand that ROEs are better, cash flows are better, but that doesn't help the cost. At the same time, local domestic competition is eating away the market. I mean,
Yeah.
Milliminst acquisition by HUL is a case in point to be highlighted. So that is the call, and this kind of what on first reaction, people thought it would be better for FMCG play, but where that 1 lakh allocation goes, I mean that tax bounty which has come is to everybody's guess. Everybody is guessing to the best of their ability. So I don't think things will happen. One thing is very clear in this market, Sakshi, at least for the last 3 months, the texture of this market tells you very clearly you have to be very, very conscious and appreciative of the fact that valuations has to be in place. If you are giving a higher P multiple, profitability growth should be, I mean, there. Otherwise, you won't find takers for that company.
Correct. Well, the markets have settled in the pre-open trade, thankfully above 22,500 as far as the Nifty is concerned, slightly better off than what the pre-open trades were suggesting, 36 points lower in trade even now. The Nifty Bank, there could be some green, as is being indicated, 0.08% higher, 48,691. Also, sectorally, the picture is slightly better off than yesterday's open. Autos could be hoping to start the day higher. PSU banks, banking, financials, pharma could also be something that could be again looking at a positive start. But again, IT could still be under pressure. In the pre-open trade, it's down 0.9%. So let's see how things improve, and flattish with a negative bias trade for the small caps and the mid caps as well. Let's in fact get to also understand, Dharmeshji, from you. We've come to the end of the earnings season. Anything that stood out for you, sir, positively or negatively throughout the course of the earnings? Where do you think the reversal could start first when it comes to upcoming Q4 earnings then?
There are many negatives. Let's not talk about that. The positives, I think, the defense companies reported a very good set of numbers, be it HAL, BEL. So there, the trajectory, the run rate remains intact with the efficiency in the operating margins and order flows kicking in. So though the stock prices have corrected, but this is an opportunity to, if you are a portfolio investor, accumulate their stocks if you have missed the initial bus. So that stood out. The other sector which stood out was the entire, BFSI space, particularly the banks, that is the public sector banks. They came out with very strong set of numbers with 14, 15% kind of advances growth, which is very unlike. Usually they do 8, 9% kind of advances growth with asset quality in place, NIM stable, and very good CASA ratio. So Tier 1 capital or capital adequacy ratio all was in place. So that can take care. There were less fresh slippages out there. Private sector banks also delivered a good set of numbers, though asset quality mildly deteriorated, and there was a concern on the unsecured lending part, which is the case with the larger part of the NBFC space, particularly who are into microfinance. And the other were few NBFCs like Bajaj Finance and couple of more who reported a good set of numbers. So I think these two sectors, but the BFSI, since it has a 38% kind of a weightage on the earnings of the Nifty, so that is the one key sector one should be watching for. Any stability out there, you can have a good, run up out there. The only one thing, if it happens, technically, this is pure a tactical call which I'm suggesting is, if FI selling just stops, if they're not sellers in the market, they may not be buying. No worries on that count. If the selling stops, this market is set to go up, meaningfully. Valuations wise, I think large cap and mid cap is already an attractive opportunity, but you have to be stock specific out there.
Okay, let's discuss a few stocks that investors and viewers can actually keep an eye out on for today, and then we'll get some stock ideas from Dharmeshji as well. NTPC Green Energy is something that you can focus on. It signed an MOU with Madhya Pradesh Power Generating Company to collaborate in the field of renewable energy via setting up of projects in the state. Biocon could be in focus too, as its arm Biocon Biologics has launched the Yesin Tech biosimilars in the US. This is going to be used in the treatment of Crohn's disease and many other diseases like psoriatic arthritis as well. So that's going to be important to watch. Already there's an indication of a higher start. PSU banks, well, the government has invited bids to appoint lead managers, brokers and merchant bankers for stake sale in select PSU banks and financial institutions. So that entire space could be in focus. Remember, the indication in pre-open is a start at 0.3% higher for the PSU banking index. Railway space, Texmaco Rail could be in focus. It signed an MOU with Nevomo for high-speed rail solutions and predictive track maintenance. Keep an eye out on that. Then ONGC, it's going to be investing 1,200 crore rupees in ONGC Green via rights issue. Proceeds are going to be used to acquire 100% stake in PTC Energy. So keep an eye out on that too. Of course, we'll also keep an eye out on some of the brokerage-related calls that are coming in. Motilal Oswal has come out with a report on APL Apollo Tubes. They have a buy rating and a target price of 1830. They believe the company, being a market leader, has delivered healthy volume growth in the 9 months of FY25 through though at expense of margins, which actually has taken a major hit. However, they expect the scenario to change for better going forward, and they expect a CAGR of 19% as far as in revenue is concerned. For over FY24 to 27, and 23% for EBITDA, 28% for PAT over FY24 to FY27 as well. Now, on Union Bank, there's a Motilal Oswal report with a buy rating and a target price of 135. They have actually pulled out some analyst day takeaways for viewers. They believe the loan growth is going to be at the lower end of the guided range of 11 to 13%. The deposit growth is muted due to the reduction in bulk deposits. The CD ratio guidance is at 76 to 78%. The NIMs are likely to be guided in the range of 2.8 to 3%. Asset quality remains robust and recoveries are healthy as well. On 361 WAM, there's a Jefferies report. They have a buy rating, a target price of 1270. They have indicated in their analyst meet takeaways that the management has reiterated synergies from its recently announced acquisition, scale up of equity broking and ECM that offer lucrative opportunities going forward from here. Jefferies on K FinTech has also come out with a report, a buy rating and a target price of 1310. They believe the stock is already down 45% from its peak, and that seems exaggerated. They estimate 40% of the revenue is linked to equity, but there are others as well which are not directly linked, and that should continue to grow too, despite this weak setup in the markets. They also believe the valuations currently reflect stronger opportunity. On the retail space, on Trent, there's a Goldman Sachs report which have a buy rating and an 8120 target price. They believe the management meet takeaways have indicated faster than expected store sales ramp up and healthy cannibalization in two main reasons for modernization of LFL growth. They believe the company expects their strategy to be in healthy area to eventually lead to higher wallet share as well. So that's also something important. Let's get back to Dharmeshji, and in fact the markets have started to trick as well. So we'll look at the first prices and then we'll come back to Dharmeshji for a view. 22,560. So slightly higher start, and that's a big breather for the investors at this point in time. The Nifty Bank better off than the Nifty, 0.3% higher, 48,808. Sectorally, when we look at the kind of action that we are seeing today, you have definitely pharma stocks that are higher by almost 0.5%. The bank index, of course, 0.4% up. PSU banks particularly 0.5% higher. That's the leading segment. Both the broader markets are also higher in trade, slightly higher by 0.2% odd in the trading session today. What's lower is the IT pack, again 0.4% of a decline, but slightly better off than what we had seen in yesterday's sell-off massacre that we had seen. Metals also slightly higher in trade, but I think it's the IT, consumer durables, realty and FMCG pockets that are flat with a negative bias. The PSU stocks are also opening up by almost 0.2% higher in trade. So stocks like PFC, IRFC, ONGC, Oil India, NTPC, BHEL, these are the stocks that are actually opening higher in trade in the PSU stocks too. Let's also look at how some of the other stocks are in fact reacting to the news flows. Let's look at the heavyweight counters: Reliance Industries, HDFC Bank, ICICI Bank, the heavyweight counters from the banking space. And we'll also look at some of the counters from the IT pack as well to see how the ticks have started off in trade. So within the banking space, HDFC Bank thankfully starting on the positive zone, 1679, not as bad as what the pre-open trades were indicative of. ICICI, let's also pull up that one. To see 0.8% higher, so that's a stronger start. Probably this space will be helping the market stem the losses in trades today. Let's also pull up some of the IT pack stocks which are continuing to be under pressure. 0.2% of a decline for the IT index. TCS, Infosys, both are starting the day on a lower note. 0.8% of a fall for TCS, 3647, and HCL Tech also 0.4% lower. Infosys, however, just a mild positive in trade, but big heavyweights like L&T are also declining. Metals pack stocks like Hindalco, you have Titan, Sun Pharma also declining in trade from the pharma space. But auto space, M&M is continuing with its up move. Remember, yesterday the up move started in the latter half, and that is continuing. Let's get back to Dharmeshji. Dharmeshji, what's the sense that you have on the opening today? Does it show that the markets would be wanting to protect the levels of 22,500 and key pockets would again step up after the massive sell-off that we've seen yesterday?
Too early to say right now. I mean, most of the trades which were there yesterday, maybe on the short side, would have been covered in this morning. So, first 15 minutes normally one should avoid taking any directional for the day trade. After that, 9:30 to 10 would be a time when one should be looking at. I would be keenly watching the breadth of the market, both on the Nifty 50 as well as the broader market. If that is showing a sign of improvement, I mean, if the ratio is 2 is to 1 kind of a ratio for advanced decline, then definitely you can see some breather setting in. It has corrected a lot and nothing falls in a straight line. So some value buying can emerge at current levels. But give it a time, 15 minutes more, and then one can make a sense of out of it.
The banks, Dharmeshji, how are you looking at the PSU banking story with the news coming in that the government has invited bids for appointing lead managers and brokers for stake sale in select PSU banks? This has been a long awaited news too. Where do you think one should keep an eye out on within the PSU banks amidst all this news development if it is going to be taking final shape?
So tactically, that's more of a, I mean, negative news from the point of view of the stock price because supply will come back, and that's the overhang with most of the public sector undertakings because government is sitting on large, shareholding, and eventually it all has to come to 75% kind of a shareholding.
Yeah.
So that supply overhang always remains there, and PSU banks, anyways, somehow it's not a favorite with fund houses. So if the allocation is there, they are very excited to get into the private sector space rather than the public sector banking space. And the retail investors are already fully invested. Stock price action has not, been encouraging, or they have not given them good returns of late. Though the downside has also been protected, so that has been a story with the banking space. So I take it a bit with a pinch of salt. I mean, it's not a very welcome thing from the stock price action, but that you have to live with it. Overall, I do think PSU banks give you a better margin of safety in this market environment, given the kind of earnings they have reported so far, and they are better bets. So, I mean, like Bank of India, Bank of Baroda could be a good, in a stable market to a mildly positive market, they should give you good stock price appreciation.
Okay, fair point. So PSU banks looking good at this point in time. Select of those stocks can definitely be looked at as well. Within the defense pack that you also mentioned in one of your key responses today, Dharmeshji, that you believe, a lot has been probably exaggerated. Numbers were still better. Order flows are continuing. So the long-term story still remains intact. What are you advising clients at this point in time? We remember over the last 5 months odd, people have been stuck at higher levels levels in most of these stocks. So HAL has
Yeah.
come off so much, BEL has come off so much, even Cochin Shipyard, Mazagon Docks of the world. But how should one be really, revising their strategies for those stuck at higher levels? Is this the right time to accumulate, average down their levels? Which are the key stocks that you believe that one should continue to do fresh investments in at the current levels as well in the defense pack?
Yeah. So here we have taken a very, normal call rather than a fancy call. And the call has been the OEM manufacturers and the value upgrade in the OEM manufacturer. Whichever companies is doing that, that should be looked into. And they, like Hindustan Aeronautics, stands very tall out there. Eventually, they would be manufacturing the entire fighter aircraft for themselves from an overall kind of a company to a manufacturer of fighter aircraft. So with light combat helicopters as well. So that looks very attractive to me. At the same time, Bharat Electronics is also good. But I'm avoiding the fancy names in the semiconductor space. Or chip makers, and also their technology driven defense companies we are avoiding as of now. uh, Majgaon dock looks very, again, valuation wise, it's more comfortable than, say, a Cochin shipyard. There again, our value buy is there. So we started this theme 1.5, 2 years back. So again, there were people who bought at the higher levels 3, 4 months back, and they are stuck or at those levels. So the only thing to get out of this kind is keep on buying at lower levels. So whenever you are stuck in a quality company and the stock price is corrected at 10%, not because of the company wrong fundamentals, but because of the market scenario. It's a very good way to keep on adding, and then it's like a SIP you are doing with your equity investments. And eventually, 2, 3 years down the line, you will see your return more multiplied, I mean, magnified than what the originally should have been.
Fair point. So that's as far as the defense names are concerned. I'll throw in some names there and let's discuss these pockets too. Retail space, I wanted to discuss Trent again with you, sir. There are brokerage houses updates coming in with higher targets. Many are believing that this could be an attractive zone to look at it. What is your own suggestion? Do you think Trent had run up ahead of its fundamentals with the way the uptrend had began? And now when we're looking at some cool off happening, does it look promising to buy at the current levels? Should one wait it out? Because the long-term story, the management continues to scale up as far as their tier 2, tier 3 expansion is concerned in terms of stores. What exactly is your viewpoint here, sir?
So the fact is evidenced by the price correction which has happened in trend. Had it not run up ahead of its fundamentals, this price correction would not have happened out there. See, I'm not doubting the fundamental story of the trend. So 30-35% kind of a CAGR for next 2 years they will be able to do, and then it will come down to the normalized level of 20-25%, because that is the natural progression. Initially, you do get 1x, 2x kind of revenue and PAT CAGR when you are just coming into the market as large as India with the reach which you have. So considering for next 5 years, if it is going to give you a CAGR of 25% kind of earning, why you would be still giving it, let's say, 80, 90 kind of a P multiple? So that is point number one. To my mind, if you are looking for, say, 15% or 20% kind of a trade for next 2 years, it is still doable on trend at 5,000 kind of a stock price. Maybe 200-300 rupees more from here. That should be, I mean, 45, I don't see slipping below 45 at least. So 4,500, 4,700 is the base for the trend, and current levels for 15-20% one can be invested. But to my mind, if I'm playing India story, I still believe in the India story and compounding happening for 3, 5 years for region. If I have, I will not play for 15-20%. Rather, I will go for, doubler kind of a stock. So there are stories out there. Trend do not fit the bill as far as that point is concerned.
Fair point. Let's also look at a few stocks that are buzzing in the broader markets, viewers. We'll keep an eye out on Tata Investment Corporation, that's up by 7%. You have Century Enka, that's moving up higher. Credit Access Grameen, Gland Pharma, Orchid Pharma. Imami Realty has been consistently buzzing over the last few days. 63 Moons Technologies, that's also buzzing in trade, about 5.5% higher. Then you also have moves on, many other stocks. as well. Digi content is moving up. So some of these stocks within the broader markets that are up and about in trade today. Among sectors, now it's reduced with the kind of gains that are limited to autos, banks, financial services, private banks, and even the PSU banking story seems to have slipped in the initial few minutes of trade itself. So autos are driving higher. Let's discuss this pocket as well with Dharmeshji. What is your own sense here on the auto space, sir? Because I think there were jitters in the last few days with respect to Tesla's entry, starting hiring here, competition increasing with BYD news coming in as well. Although the OEM manufacturers here and their leadership has consistently talked about that they are not worried about any external competition. M&M started to rally because there was a 53% upside given by a brokerage house yesterday. Your own sense, how are you approaching this entire auto space? Where do you find value at this point in time, sir?
So as far as managements are concerned, they don't have a choice. They have to say they are not worried about the competition. But the fact remains the competition is there, and there will be a lot of disruption coming into this auto space. Be it four wheelers, I mean the car segment, or the two wheelers. Two wheelers we are already seeing a lot of disruption happening. So the competition is going to heighten up, no doubt about that. And the market size remains the same. I mean, you already had 2 good years of auto sales, and this year you are seeing a consolidation. You can again have a 2 good year of auto sales, and the good year is like 10-12% kind of a volume growth. So that is so incremental, capturing of the market share will be difficult for current incumbents. And if Tesla enters the market, it can be a game changer for India as well. Because we don't know what duty, I mean, custom duty price they will be entering. If it is 20-30%, then it's everybody knows what kind of a competition is going to be there. People are still expecting it to be 50 or 70% in that bracket. So it again becomes a bit on a higher side on the premium segment. So that's a big challenge. Two-wheeler space, all at electric and others, Ether and everybody is fighting for the EV space. I do think that this year there would be trades. I mean, volatility and swings will be there. But this year would be a settling year and the disruption discounting year. You will have your cards in place, which are the auto companies look forward to for next 2 years. So I don't see a secular move in the auto space this year per se. Having said that, let me also say that type of correction which we have already seen in most of the OEM manufacturers, be it Hero, Bajaj, M&M, all, I don't see a further downside from here. But as far as appreciation is concerned, we have to give it time for this things to settle down and see a clear sky and then take a call on that.
Okay, fair point. Well, Dharmeshji, we will then thank you on that note for being with us in the morning edition, helping us sift through the opportunities and again look at with a cautious eye where challenges still remain in this current market. Always appreciate your time with us on Business Today,
Thank
and
you so
here's
much, Sakshi.
hoping that
Thank you.
things improve for the better sooner than we hope them to be or expect them to be. Let's in fact also get into the second segment and welcome another guest on board. We have Mr. Kranti Batini now joining in, Head of Research at Wealthman Securities. Warm welcome, Mr. Batini, and thank you so much for joining in. Let's get your sense going as far as the current setup in the markets is concerned. Do you think, are we nearing the bottom anywhere when it comes to the kind of sell-off that we have been seeing? I mean, we're in the fifth consecutive year or fifth consecutive month of the kind of sell-off in the Nifty that is concerned. This could be the longest streak of losses if we post another month of loss in the last 28 years. Something which, of course, not just the current set of the new investors, but even the previous set of new investors have not really seen. So it's definitely a challenging period. People are losing the kind of belief that they had in the extreme resilience in the Indian markets as well, and they are not sure as to what is coming in. What is the sense that you are deriving from your wealth of experience that you have been seeing the markets over many years? Are we at the end of the fag end of this bottoming out cycle, sir?
Sakshi, it's a very interesting question you posed to me. But Sakshi, my sense is we are nearing to the bottom. Okay, that's what I can sense at this point of time. But here the question is, the DIS have been shielding the markets till now. Going ahead, given the kind of fund flow the DIS have been receiving, if they are resilient, yes, definitely we can try to hold on to this level. But the problem, the unprecedented sell-off by the foreign portfolio investors in the month of Jan, in the month of Feb, that has been creating extra pressure on the markets at this point of time. Uh, there was a market saying at this point of time, sell India, buy China. That's a kind
Uh-huh.
of narrative that has been playing uh, uh, right now, that has come back. In fact, when couple of months back, the same kind of narrative that that came in because of the domestic strong liquidity, we could able to sail through. But on a comparative basis, given the kind of measures that Chinese government they have did in the recent past, recent fortnight, to sending a message, a direct message to the world, they are business friendly at this point of time. So that message has been strong, and also the relative valuations of China, and also the opportunity, despite of the hue and cry here and there, that is giving us some sort of interest towards China at this point of time. But on longer term basis, given the kind of predictability of the policy, and also policy continuity, and business friendly atmosphere of India policy makers are concerned, definitely India is a favorite destination for the investors who are looking forward for long term. Okay, that makes the long only funds to look back to Indian markets at this point of time, Sakshi. So, in the medium to short term, this narrative has been playing well at this point of time. And also, Sakshi, I am quite optimistic despite of the tariffs news that has been hampering the market sentiment in the medium to short term. But there will be a point Trump administrations will realize, okay, and they will get into try to get the consensus, and also negotiating with the other countries to get the mutual benefits for everyone. There will be definitely unintended consequences for US administration if they keep on imposing tariffs on every country. That they are going to estimate, and they are also going to change their narrative in the coming weeks, which is going to be a positive for the markets. So if the investor is a long-term investor, for suppose if I want to be in the market for minimum, if I'm bringing the money for more than 1 year, definitely these challenges are definitely short-lived. There will be a rebound in the market. So one can keep this as the first price point to accumulate the stocks. But here, the issue here, Sakshi, one need to keep in mind, quality should be the template.
Yeah.
The markets are going to be very selective. It's not like what we witnessed in the past 2 years. Whatever investors are buying, they keep on giving returns to them. But going ahead, the valuations and the quality should be the case for the investors going ahead. So try to pick up the quality ones. Nothing to worry. If the investor is having a time horizon more than 1 year, I believe this is the right time to start picking the stocks.
Right time to start picking the stocks, and the prices are giving you that opportunity at this point in time. Mr. Patini, also wanted to get a sense on the overall valuations. That was a big talk point on the Indian markets, that they have run ahead of fundamentals. Earnings are not supporting the kind of valuations that we were trading at, especially when it came to the mid and the small cap space. The valuation talk point was further up and ahead. After the recent correction that has come in, I mean, we are down 12% as far as the benchmark is concerned. We are down about 17 odd percent as far as the mid and the small caps are concerned. Are you looking at these, valuations as more comforting at this point in time, or do you still feel that still they are on a higher side, and therefore the premium that we expect, or the upside that we expect, could be capped?
Sakshi, see, we need to define in such a way, okay? We need to get into stock specific at this point of time. We
Right.
can't paint every stock as a high value zone or something, okay? It should be stock specific and sector specific at this point of time. Of course, definitely, as you mentioned, there are some pockets. Definitely, there is a froth, no question at all. But it should not be paid. There are some small and mid cap companies which have a strong order book, and also strong earning visibility, and also the quality of management is good. They can convert every challenges into opportunities. those kind of companies, they got corrected from its peak of around 30 to 40%. It gives a good opportunity. There are some companies, okay, even though despite of they corrected from its peak 30 to 40%, they have risen from 200%, 300% from its peaks. Still, there is a fraud. Okay, we are talking about one way a stock got corrected from 100 to 60 rupees, 40% correction. But we also need to think this same stock, it has risen from 5 rupees to 100 rupees, and currently it is still at 60 rupees. Okay, those are the pockets where the overvaluation froth is still there.
Got that. Now, Mr. Patini, since you're saying that this is a market which needs to be very, very selective approach needs to be there in terms of sectors and stocks, any top 2 or 3 sectors that you believe there is valuation comfort, there are initial signs of a recovery happening, where the recovery could first start when the market sentiment turns for the better? Which are the key sectors that you believe where things could turn for the better, sir, now?
Sakshi, despite of the fair valuations or some sort of a pricey valuations, still healthcare looks good to me. Healthcare, the hospital chains and all. There are some pockets
Okay.
of correction we do witnessed, but they are more insulated at this point of time, and there is a greater emphasis is given in this budget also, in the budget speech also. There will be a lot of emphasis towards the healthcare tourism, and also the healthcare industry is concerned. Still, it's look vibrant. And what we are witnessing in healthcare is there is a complete uh, there is a the fragmentation is now getting into completely organized at this point of time. So that gives the benefit for the listed players over a period of time, because healthcare is one of the highly fragmented industry, except a few major players who have some sort of market share. But going ahead, what we can sense at this point of time is these listed players can gain the market share over a period of time. So these are the stocks not bothered about what Trump administration is doing and how the things are taking place by and large. And healthcare is a stable industry and it's growing industry. Healthcare names like Aster DM, Apollo, and the other listed ones looks very attractive on a selective basis, Sakshi. And the
Okay.
other sector is infra. The stocks have witnessed a healthy correction. So investors with long-term horizon, one can look at infra in their portfolio names like L&Ts of the world at this point of time, or newly listed companies like Afcon, which have a strong pedigree and also strong track record in terms of the executing the projects, looks attractive to me.
Fair point. Okay, so those are the key spaces that one could definitely look at. Is there any space which is still in the avoid category, Mr. Patini, where you believe the valuations still do not justify, and there could be some more pain that needs to be taken out, and where investors need to be a little more cautious? Do you think are there any pockets like that?
In terms of the chemicals, I try to avoid it still at this point of time. Still, despite of the valuation comfort what we are getting, but still I try to avoid in the medium to short term.
Yeah.
But by and large, right now I'm focusing on very stock specifics actually. Okay, we can get into very micro level, and top down approach has to be maintained while selecting the stocks at this point of time.
Fair point. Okay. Then let's look at some of the other pockets. PSU space I wanted to discuss with you, Mr. Patini. Now, defense, railways, or power related spaces, these were the spaces which were erstwhile favorites. We have seen a meaningful correction in all 3 pockets. Where do you think investors can now afresh look at PSU stocks, and where do they need to continue to stay away from?
Sakshi, the PSU space, okay, it has become a very wider universe at this point
Yeah,
of time.
yeah.
We have the defense, and we have the railways, we have the PSU banks, and we have the other PSU CP stocks. It's a very wider universe actually. In terms of the stock picking is concerned, I still like names in the defense, okay, despite of the view of the high valuations people tend to say. But I still believe, given the kind of order book size and also every defense companies, names like Garden Reach and Mazgaon Dockyard,
Yeah.
Hindustan Aeronautics, or BEL, these companies' order books are quite strong and they have the strong execution capabilities to execute the orders, which in turn increases the revenue. So I still have a valuation comfort in these names. So any dip in the stock, I would like to accumulate these stocks for a medium to long term basis in terms of the defense space is concerned. With respect to the railway space is concerned, still the valuations are right now entering into a valuation zone. Valuations are entering into a attractive zone. If there is some more correction, that the time one can the margin of safety will go up in these railway names. If the investor is a long term investor, definitely one can look the railway stocks. With respect to the PSU banks are concerned, I will be weighing on very stock specific, and also the risk reward in PSU banks is in favor. Uh, but I am not in a hurry to go and buy PSU banks at this point of time. I'll be very selective in terms of the picking up order of PSU banks are concerned. So PSU have a wider meaning at this point of time. But if you ask me what looks very attractive in terms of the PSU university is concerned, the first order definitely is going to be defense.
Okay. Let's look at a few stocks which are actually buzzing pretty strongly in trade today. The Nifty next 50 names have interesting names. Zomato is up by 2.5%. You have Geo Financial Services that are up by 1.2%. Remember, both these stocks have a trigger of inclusion on the Nifty as far as March 25th is concerned. Then you also have stocks like Info Edge that's buzzing. Adani Group stocks are actually buzzing today. Adani Power is up 4.5%. Adani Energy Solutions about 2% higher. Adani Green Energy is also up. Ambuja Cements is also higher in trade. So the Adani Group stocks are actually picking up pace. You have several other stocks that are also buzzing. But you have TVS Motor, you have Power Finance Corporation, Dabur is up, Macrotech Developers. Many of these stocks are actually finally coming back into action. And you can see 22,600 is back on the Nifty. So there is some improvement in sentiment across the board too. Anything that you would like to suggest on Zomato and Geo Financial Services, Mr. Batini? How would you look at these two pockets? Remember, again, there is this view that since Zomato and Geo Finance still trade at higher valuations, they would further make Nifty look heavier at this point in time, something which might again keep the FIIs at bay. But for the stock specific spaces, Zomato and Geo Finance, how do you see them?
Both Sakshi, Zomato is concerned, it's by and large the futuristic business model, and the Nifty have a comfort. Despite of Zomato posting last four quarter results as losses, but we have the comfort to, given the kind of futuristic business models in terms of the volumes are concerned, market cap is concerned, they got the opportunity to get into the top 50. But these are all both are futuristic business models. So the Zomato, which is a become a household name at this point of time, there is an ample opportunity to get into the the tier two cities of the world in terms of the food delivery or the quick commerce business is concerned. So there is a ample opportunities. Of course, if any technology-led, technology-driven, disruptive tools that comes up with the pricing, that's what we are witnessing. Zomato, the stock had a stellar listing. It corrected up to 60 levels, touched the level of 300. Now at 227 level. So investors with high risk appetite, definitely they're going to look at a company like Zomato. Even though foreign portfolio investors also definitely they're going to look at names like Zomato. It's a welcoming move, including them in terms of the Nifty is concerned. As per the Geo Financial Services is concerned, they're still the company is at a budding stage. They're entering into stockbroking and also the asset management business is concerned with a strong pedigree. How they are going to make the things in the coming few quarters, that's going to determine the Geo Financial's futures. But these are both are strong futuristic business models, Sakshi.
Absolutely, got that. Let's look at some of the other pockets that are buzzing. You know, NBFC space is actually showing us some strong moves today. Credit Access Grameen is up 5.5%, 361 WAM, 3% higher. Remember, there's a brokerage house update and a higher target on this one. SBFC Finance, IIFL, Bajaj FinServe, you have Poonawalla FinCorp, then also Nuvama Wealth, Geojit, 5-Star Business Finance. Both the AMCs, broking spaces, they're actually, and the NBFCs at large are looking up at this point in time. Any suggestion here, Mr. Batini? Any key stocks that you like within this entire basket?
In terms of the NBFCs are concerned, the valuations looks very attractive. They have not done anything well in the recent past or in the past 1 year. I just will be in a wait and watch mode given the kind of market sentiment is concerned. I'm not in a hurry to back these NBFCs stocks.
Okay. Okay.
So I try to avoid in the medium to short term at this point of time. At some point of time, we are looking NBFCs, but we are not in a hurry to jump and buy these stocks at this point of time, Sakshi. Sakshi,
right.
just to make a point for the investors, nuclear power is one of the new emerging theme that is emerging in
Okay.
India. It is at a still very nascent stage. Given the kind of the GDP and also the power demand that's going to emerge, the government also making the changes in the nuclear power civil law is concerned. So it throws ample opportunities for the investors going ahead. We have witnessed in the green and solar energy how the momentum was built up in the recent past. But next big theme of energy is going to be the nuclear energy theme. Very few players are in this theme, but it throws ample opportunities for the new other companies to get into this kind of theme. So when we discussed 7-8 years back or 10 years back, defense as a theme, it was not. It was at a very nascent stage. The same kind of theme, the nuclear energy at this point of time. So investors can keep in their watch list the companies which are involving or getting into nuclear power and energy. That's going to play a big theme for the investors. It is at a very nascent stage, so investors can keep this theme on their radar.
Hey, fair point. Well, thank you so much, Mr. Batini, for being with us on the show today and helping us navigate through various pockets of, opportunities in this current setup in the market. So what's also good is that despite being a truncated week, we are seeing some ticks higher on the Nifty yet again. 22,600 is back with us. So probably seems like the bulls are not yet willing to just let go. And that's a bit of a positive. Across the board, there is some buying emerging on autos, consumer durables, financial services, even the broader markets, mid and small caps, oil and gas, pharma, FMCG. These are the pockets that are holding up. And the India VIX is down, thankfully so, in trade today, 14.03 levels, 2.8% lower. Realty, metals and IT still remain to be the pockets where some losses can be seen. But let's hope that this also improves for the better as we inch closer to the second half of the trading session as well. With that, we wrap up right here. But in case viewers, you have a lot of questions that whether you should double down on your investments in some of the stocks in your portfolio at this current time, where is it that pain could continue and therefore exiting could make more sense. The strategies that you should be adopting, well, 12 noon is when we come up with daily calls. Top 2 experts within the market sphere will be helping you out with your own stock specific queries. So you can send them to us and get your queries resolved live on the show on daily calls. Stay tuned.
Good afternoon, ladies and gentlemen. A very warm welcome to you on this wonderful February afternoon on Market Masters, our special show where we get you to meet the